Good morning. Welcome to the BRICKABILITY Group PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish response to where it's appropriate to do so. I'd now like to submit the following poll. Before we begin, we'd like to run a short video.
We are BRICKABILITY Group PLC. Through our 4 divisions, we are specialists in sourcing and supplying bricks, timber, cladding, roofing, plumbing, doors, flooring, and renewable technologies to the construction industry, driving industry change through our approach to our people, our partners, and the planet, and challenging ourselves to be carbon net zero in our own operations of our sales businesses by 2030. Quality materials for a sustainable future. Always striving to exceed expectation. Supporting our customers to design and build sustainable developments where people can thrive. Innovative thinking and an entrepreneurial spirit brings together individual businesses who all offer specialist products and services but serve the same markets, working together for the future. We are proud of our reputation. As market leaders, we offer unsurpassed industry knowledge and experience, and we are proud of the long-term relationships we build, constantly striving to enhance our comprehensive, stylish, and innovative portfolio of building products and services, and working with everyone in the supply chain to understand the needs of our customers to deliver successful projects. We aim to connect with the communities in which we live and work and improve our social impact. The BRICKABILITY Group Foundation is a registered charity set on building a better future, dedicated to supporting our communities, initiatives and individuals here in the UK. We are BRICKABILITY Group PLC, delivering on every level.
I'd now like to hand you over to John Richards, Chairman. Good morning, sir.
Good morning, and good morning to everybody on the call. The highlights of our first half really are centered around the fact that it's been a resilient performance across all group divisions in the first half, despite what are adverse macroeconomic conditions. We benefited from growth in both distribution and contracting divisions, but we've also benefited significantly from our strategic decision to diversify the business and expand into new products and new end market areas. That's been a big success for us. For the 6 months ended 30th of September 2023, revenue decreased by 7.9% to 324.8 million. And on a like-for-like basis, revenues are down 14.4%. However, adjusted EBITDA increased slightly to 25.6 million. Post-period, the strategic acquisition of Topec Limited further diversifies the group into new end-use areas, and this now provides the group with a full range of cladding capabilities. We are continuing to look at acquisition opportunities, more from Alan on that in a while. Our ESG strategy is progressing on time and on target, and the board remains confident in the group's ability to continue to deliver on its strategy. The board is pleased to recommend an interim dividend of 1.07 pence per share, reflecting the performance of the business in the half year and the board's confidence in the longer term outlook for the group. Let's move on to the next slide. We've chosen here to look at the brick and the home building market of all of our product areas. And brick dispatches this year, the 2023 calendar year, are forecast to be 1.77 billion. That's for the whole industry. And that's down from over 2.5 billion in the previous year. It is the lowest for the decade, and it mirrors the number of dwelling starts in the UK, which you can see on the top right chart, which is forecast to be in 2023 only 156,000 compared to around 200,000 in the previous 2 years. This is probably not news to everybody. It is tough in the private housing market at the moment, but not on this chart is worth reiterating that general construction, public housing and architectural specification are all going well, which is why our diversification has helped us. New builds by property type, the bottom right chart, 29% detached, which is down by 3%. However, just above, semi-detached homes are up by 3%, correspondingly to now 30%. The fact of the matter is that there's not huge amounts of inventory in GB factories at the moment. If you look at the bottom left chart, you'll see in the orange bar that current brick stocks held at GB factories are just over 500 million. That by no means represents a stock overhang. That is a sensible working inventory once a strong housing market returns. By comparison, if you looked at 2009 banking crisis time, there were over 1.1 billion bricks in stock and an even smaller brick market. That stock overhang created pressure on price. There isn't pressure on price as we stand right now. Imports have played an important part in GB brick usage. Last year, for example, 570 million of the 2.5 billion used came from imports, mostly continental Europe. And there still remains a need for imports into GB building because quite simply, there is not the capacity for us to cope with a strong market in terms of brick need. If you turn the page, GB capacity for brick making has hovered around 2 billion bricks at best for a number of years. Right now, there are a number of brick factories from Ibstock and Forterra that are being mothballed or run at a slightly slower pace. And indeed, Ibstock has permanently closed Ravenhead factory in Lancashire, taking out 45 million bricks a year from the overall capacity. Now, there is new capacity coming on. We note here that Ibstock have a factory being built in the West Midlands called Atlas, and Forterra have new capacity coming on in Leicestershire at Desford, and they're refurbishing a factory called Wilnecote in Staffordshire. This will bring about 200 million to 300 million extra bricks when it's fully commissioned and operational into the market. However, while that will give a GB capacity then of around 2.2 billion bricks per annum, all the incremental bricks being made are wire cut. There are basically two ways of making bricks. Either wire cut, where the clay is extruded from a die and then chopped into brick shape by wires, hence the name wire cut, and they're prevalent in the Midlands, in Wales, in the North and in Scotland. And then there's stock bricks or soft mud bricks or moulded bricks, completely different technique of making. They are moulded and they've always been prevalent in the southeast. I said before, all the new capacity is wire cut. That is not suitable for the southeast, would not be approved by planners in the southeast. They insist on soft mud, moulded stock bricks. Of the GB capacity of 2.2 billion, only 590 is soft mud, stock bricks. More than that number are needed, and that's where imports come into their own, because 90% of the imports coming in, mostly from Belgium and Holland, are that stock or soft mud type, and that is what planners insist on in the southeast. It helps us hugely, the requirement for imports, because after Wienerberger, the manufacturer, the BRICKABILITY Group is the largest importer of these bricks by far into GB. I hand over to Mike for some finance numbers.
Thank you, John. That's great. Thank you very much. So the headline for this slide is that the group has delivered a solid performance really in half one, despite the market headwinds that John alluded to just a moment ago. Moving down line by line, group revenue at 324.8 million is a decrease of 7.9% year on year, which, when adjusting for the acquisitions that we made last year, is a like-for-like decrease of 14.4%. Despite the fall in revenue, gross profit of 55 million is actually a fraction ahead of the same period last year. As a result, the gross profit percentage has increased by 130 basis points to 16.9%, reflecting the recovery of significant materials price inflation that we saw across our roofing businesses that sit in our contracting division last year, together with a change in the mix of the business unit contribution during the period across our group. Adjusted EBITDA at 25.6 million is also slightly ahead of the previous period, with the adjusted EBITDA margin increasing by 70 basis points to 7.9%. Adjusted profit before tax at 21.8 million is 2.8% lower than the prior period. Other items of 5.8 million are mostly acquisition related, and there's a detailed breakdown in the presentation in the appendix, and our presentation is available on our corporate website if you haven't already got it. This gives a statutory profit before tax of 16 million, an increase of 8.3% in the prior period. The tax charge of 4.6 million is comprised of two items, 5.8 million relating to adjusted profit before tax, and then tax on other items, which is a credit of 1.2 million. That leads to a statutory earnings for the period of 11.3 million, which is 1.7% increase on the prior period, and adjusted earnings per share of 5.3 pence, or a decrease of 11.7% on the prior period. This is driven largely by the increase in the corporation tax rate. Net debt of 30.9 million compares with net debt of 27.4 million in the same period last year. And I've got a slide in a moment where we go through the waterfall and break that down in a little bit more detail for you. And as John mentioned earlier, the board has recommended an interim dividend of 1.07 pence per share, which is an increase of 5.9%. On this slide, the divisional performance, it just breaks down our segments or our four divisions. What you can see is bricks and building materials revenue at 229 million is 15.2% decrease versus the prior period. Within this, timber revenues fell by 22%, driven entirely by price. Excluding the impact of timber, bricks and building materials revenue fell by 11.7%. Now, the challenging market conditions and that John was talking about before, particularly in the private house building sector, have seen the market for UK brick dispatches fall by approximately 28% in the 6 months between April and September. Our brick volumes in the bricks and building materials division fell back by a similar amount. At a revenue level, however, this was partly offset by year-on-year price growth. Revenue of 53.3 million across the importing division is a decrease of 1.6% on reported figures for H1 FY23. Adjusting for the acquisitions, revenue was down 34.1% on a like-for-like basis. The market for imported bricks is estimated to have fallen by around 40% over the period, with volumes across the importing division in line with this market number, whilst the year-on-year price increases partly offset the impact on revenue. The distribution division revenue of 33.2 million was an increase of 7% on the previous period, driven by customer and product diversification with growth across all of the businesses in the division. And finally, contracting division reported revenues 23.4 million, or up 17.8% on the prior period, through the continued recovery of the material price inflation I mentioned a moment ago, and also the resilience of the house building market in the mid to higher end of the market in the southeast. Moving down to the table at the bottom, the EBITDA, adjusted EBITDA table, you can see the impact of the reduced demand for bricks together with the timber price deflation has, of course, flowed through into the profits of bricks and building material and importing divisions. Distribution EBITDA of 5.2 million was an increase of 5.6%, and the divisional average EBITDA margin reduced slightly by 30 basis points to 15.7%, largely as a result of the business unit contribution within the division. Contracting EBITDA 3.7 million was an increase of just under 44%, with the EBITDA margin percentage increasing by 290 basis points to 15.8%. And that's what I previously mentioned. That's the recovery of the material price inflation that we experienced in FY23. So at a total level, Adjusted EBITDA, as I said previously, at 25.6% is marginally ahead of the same period last year. If you can move me on to the next slide, please, Paul. Thank you. So finally from me, just to run through the cash flow for the period. Net debt at the end of the financial year, March 23, or our opening debt here, was 8 million net debt. And the group generated 22.6 million of operating cash flow in the period. Working capital was an outflow of 19.3 million, which reflects our mid-year working capital profile. And so this time last year, for instance, that number was 17.4 million. So you can see we have an outflow during the first half of our year, and it always comes back into the second half of the year. The key movements being on the working capital being 1.2 million increase in inventory, 2.3 million net outflow trade debtors and creditors, 2.1 million net outflow relating to earn-out consideration accounted for as remuneration, and this is where our deferred consideration appears in three parts in the cash flow actually. So some just down to accounting, some sits within working capital, some sits within, you can see there's a bar there for deferred consideration, and some sits within the interest line as well. And then there's 13.7 million in that working capital number. There's 13.7 million of accrual movements and payments, which was, as I was alluding to before, are largely timing related, and we expect to unwind during the course of the second half of the year. The other main items of cash flow were 4.7 million relating to the deferred consideration, which I referred to a moment ago, in respect to 6 acquisitions, and 4.5 million of property purchases, including a showroom in London and an office in the Yard in Wales. And really, we don't have a lot of maintenance capex in the business, so capital expenditure in this case is property related, and this is where we are effectively swapping from leaseholds to freeholds. So this is a choice. We're not committed to a large capital outflow, and that's one of the benefits of being an asset light business. So net debt at the end of September was 30.9 million. Post-period, as you'll be aware, we announced the acquisition of Topec, so we expect net debt by the end of the financial year to be somewhere in the region of about £44.5 million. And with that, I will hand over to Alan to run through some operational highlights.
Thank you, Mike. A good performance despite a challenging environment in the first 6 months of the year. The group has benefited from its diversified multi-business strategy. Strong performance and growth in cladding with SBS Cladding and Taylor Maxwell & Co. U-Power, our renewable energy solar panel business, continues to grow, and we expect the growth rate to accelerate over next year. Forum Tiles is growing and contributing now to the group profits as a startup business 2 years ago. FSN Doors, again, a smaller business, higher margins, and Bricks has had its best year ever and has a very strong order book moving forward. The contracting division has grown. The mid to upper end of the housing market remains very, very strong at the moment, and we have a full order book for most of next year. The German roof tiles are expected to be online and being manufactured April, May next year. We're continuing our IT system of operation or financial rollout. Cost controls and disciplines remain, and post our 6-month figures, the acquisition of Topec, the cladding business, was made. If you could turn the page, please. Acquisitions, we did a small one earlier in the year within SBS, the cladding business, and then we completed the big one, Topec, for 45 million, 65% upfront in October. This complements the group's existing cladding portfolio, as we said, Taylor Maxwell, SBS Cladding, and we also have architectural facades. The group now has a full range of cladding capabilities: design, fabrication, supply, and also installation. Pipeline moving forward, another specialist cladding contractor, more or less identical to Topec, just in a different part of the country, the southeast of England. A specialist roofing contractor
We own other roofing contractors that are very much in the housing market. This one is a flat roofing business that does offices, schools, etc. And then we're also looking at a roofing contractor group, which has 9 divisions. If you look at the next slide, page 13, when we floated originally, we only displayed the house, and we had probably 6 products at the time. We now have 12 products, and we've also moved the dial to diversify the business. So 50% of the group business's net revenue is now non-brick, and we have all sorts of cladding products available, non-combustible, obviously. If you could then change to page 14, the outlook, the fundamental drivers of our industry still remain strong. We have built a robust and increasingly diverse business with a broad project portfolio. We have very strong customer relationships and good cost control discipline, and the ability to adapt. The gap between supply and demand for housing indicates significant potential for further growth, and we are continuing to look at other acquisitions alongside our continual organic development. In our October trading update, we noted that the volume reduction experienced by house builders and manufacturers were expected to have an impact on the second half of the year through the financial year. However, the board remains confident in the group's ability to continue to deliver on our strategic objectives. I'll hand back to you now, Paul.
Fantastic. Thank you very much indeed there, Alan. Thank you very much indeed to you all for the presentation. Ladies and gentlemen, do please continue to submit your questions just while the team take a few moments to review those submitted today. I'd like to remind you the recording of the presentation, along with a copy of the slides and the Q&A, can be available via your dashboard. We've received a number of questions, both pre-submitted and throughout today's meeting. So perhaps if I can start with the first one, which I think I'll direct to you, John, actually, if I may. It reads as follows. Do you have a precise date when Frank Hanna will take over as CEO from Alan?
Yes, Frank will start on the 15th of April next year.
Fantastic. Thank you very much indeed. Next question we've got here, and I think this is probably more one for you, Alan. It reads as follows. Can you give an update on the price inflation in the sector?
It's very strange, actually, you mentioned that. We've actually had a price increase notification from Ibstock today, saying they're going to have a price increase of 6% from March. So if Ibstock are having a price increase, it would follow the Wienerberger and Forterra. Maybe we'll have a price increase then. So but prices, we didn't have any price increases during this year at all. Obviously, last year we had lots of price increases where bricks probably rose by 30 to 40%. Prices have moved down slightly, and then they've sort of stabilised. But Ibstock, as I said, have just announced they're having a price increase of 6% in March. So I would expect the other manufacturers to follow as well.
Fantastic. Thank you. And sticking with you, I think, Alan, for the next one as well. Please, can you give an update on the Power performance? Has this been better or worse than you thought when you acquired it?
Obviously, the new regulations came in from June, and prior to that, all of the big house builders were putting in footings and not starting units to obviously avoid having to build to the new regulations. So I would say it's been slower than we expected, but the actual order book on orders we've received is actually double the same stage as last year. So we're contracted to do 16,000 roofs a year in the southeast with Barratt's, Taylor Wimpey, etc., etc. Of each roof is £2,800 to £3,200 fixed. So last year we did £10 million turnover. So if you do the maths, when we get the numbers fully moving, we're going to go from 10 million to 40 million within a couple of years. It's just a case of it all getting going now, and it had to start from June this year. So it's been slower than we thought, but we are expecting quick growth. So we'd expect Power to go from, as I said, 10 million to 30 to 40 million really over the next two years.
Fantastic. Thanks, Alan. The presentation suggests there isn't sufficient UK capacity for bricks once the housing market normalise. I thought there was more capacity coming online. Please, can you explain? I think this was one, John, that you were touching on earlier. If I could just hand back to you.
Yeah, the capacity in GB to meet brick demands hasn't been there probably for 25 years. UK kept closing brickworks every time there was a slight downturn. And where we are now is a capacity of just under 2 billion bricks. With the new capacity that's coming online, that will take it to somewhere between 2.15, 2.2 billion bricks. But if we build 200,000 houses a year, which most years recently we have done there or thereabouts, you need 2.6 billion bricks as a minimum in order for those homes to be built. With a capacity of just under 2.2, you only have to do the math to see that there's going to be at least 400 million imports needed per annum once we're back to a normal market.
Fantastic. Thank you very much indeed, John. What have we got here? The next question reads as follows. Given the market and economy, how affected has Brickability been by bad debts in the past month? Probably one for you, Mike.
Yeah, thank you. Yeah, so we should never be complacent, of course. We obviously monitor our debt situation all the time. However, a large amount of our debts are covered by credit insurance. So we haven't really seen much of an impact in our half one results. But yeah, as I say, it's not something we're complacent about, and we do spend a lot of time looking through that.
Fantastic, thank you. And probably sticking with you again, actually, Mike, as it's a CapEx question. What was driving the continued CapEx spend?
Yeah, I think, as I went through on the waterfall, actually, we don't have a great deal of maintenance CapEx because we are an asset-light business. So what we've done is we've taken the opportunity, when the opportunity arose, to convert leasehold properties to freehold by buying those freeholds. So in our forecast going forward, we made some assumptions that we will continue to do that, but it's very much choice, and we'll evaluate each opportunity as it arises.
That's great. Thanks, Mike. There's a lot of mention about diversification strategy. Please, can you provide some more detail? And probably, I think that would be one for you, Alan.
Yes. No, I mean, we've taken bricks to quite a high level. We're about 22.5% of the market. So we've very much been looking at a business, again, that won't be affected by the house building side. So the acquisition of Topec, they only, at the moment, they're doing student accommodation, hotels, office buildings, etc. They're not involved in the house building market. So we've been looking at businesses that aren't directly involved in house building. When we started, Brickability was 85% house building. That was the reason we're so keen to purchase Taylor Maxwell, because there was only a 9% customer overlap, but they're very much in with the Morgan Sindals, the Higgins, the Wilmot Dixons, etc. On the construction side. So we've looked to diversify the group. So we're only 50% in the actual housing market now, and 50% non-brick. Also, all of the other businesses like U-Power and the cladding are at higher margins than bricks as well. Topec, his net profit is around 19-20% EBITDA, and the U-Power solar panels, we're selling those between 30 and 40% profit margin, whereas bricks is around 14.5%. So we're looking just to diversify into other areas and also at higher margins.
Thanks very much, Alan. Next question we have here kind of splits into two parts, and I think I'll take the first part actually, which reads as follows. The company's been active with acquisition since IPO. Two questions on this, please. The first one, realistically speaking, what's the growth potential through acquisitions over the next 10 years? 2 times current revenue, 5 times? And I think that's one for you, if I may, John.
Yes. Well, when we floated in the summer of August 2019, we targeted 500 million of revenue within 5 years. Now, we achieved that within 4 years, because much of building materials distribution is fragmented, still remains fragmented, and that's one of the reasons we have such an active pipeline of opportunities. We expect that we can get to the 1 billion mark through organic and acquisitive growth within the next 5 years, and that's the target we're setting ourselves.
Thank you very much indeed, John. The second part of this question, which is an interesting question actually, how would the ROI on the recent acquisitions compare to share buybacks? One cannot help but wonder if better to buy back the company shares at a current price, especially when considering the risks associated with acquisitions. Perhaps, as I say, one for you there, Mike.
Yeah, thanks, Paul. We evaluate all options, including share buybacks as well, and we have discussed this with our many of our institutional shareholders as well. The ROI on our acquisitions that we've made thus far is very good, as you'll see in our numbers. And the business has made, well, a number of acquisitions before IPO, but it's done 12 acquisitions post IPO, which have all been successful and added to the profitability and the growth and diversification of the business, as we've all been just talking about. So we believe as a board that the value, the shareholder value that we generate through acquisitions is still the right strategy for the group. So, you know, say we're cognizant of the point that's been made there about share buybacks with the rating as it is at the moment on the group. But we think, I think, as we've all been saying, that this is a sort of lull in the market, and we believe very much in the growth strategy of the group. So yeah, so that's how we're looking at the moment. There's also, I can see another question in the Q&A which relates to the, so if you don't mind, Paul, just pick this up at the same time about the debt facility. It says, having increased the debt facility, we look to use this for future acquisitions in a weaker market for competitors. And the answer is yes. You know, we've increased the debt facility to give us some headroom. Alan outlined that we've got an active acquisitions pipeline, and we're always looking at things. So yeah, that would be the intention, and that fits with the question about the share buyback and the IRR on acquisitions. That's something we would continue to pursue.
Fantastic. Thank you very much indeed there. What have we got here? Are you doing anything in relation to cost cutting, staff redundancies? What happens to employees and contractors of newly acquired companies? And probably one for you, Alan.
On certain businesses, we are having some cost cutting at the moment, where the sales have fallen back. But in other parts of the business, we're actually in new power and architectural facades, etc. We are employing more people. So some of the businesses, even though the housing market has slowed down, are growing. So we are actually taking on more staff, but some of them more affected in the housing side. I think we probably made 30 or 40 people redundant recently.
That's great. Thank you. Thank you very much indeed. That covers off all those questions that we have through from investors. Of course, any further questions that come through, we'll pick those up, and the company can publish responses where appropriate to do so. On that basis, John, perhaps I could just ask you for a few closing comments before I redirect investors to provide their feedback, which I know is particularly important to you and the team.
Yes, of course. Well, I think we can summarise it by saying it has been a robust performance in the first half of our year, despite the headwinds that we've faced. And there are clear headwinds, particularly in the private housing arena, as people on the call will be aware. We've benefited enormously from the diversification of the business. And as Alan has said, it was around about 85% of our business into private housing when BRICKABILITY IPO'd, and today it's around about 50%. And the acquisitions are making that number fall further still. Our growth aspirations remain very strong. Despite the cyclical headwinds, housing fundamentals deep down remain very strong as well. So as a board, we remain ambitious and we remain confident as we look forward to the future.
Fantastic. Thank you very much indeed. John, Alan, Mike, for updating investors today. Can I please ask investors not to close this session? You should now automatically be redirected to provide your feedback in order the management can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of BRICKABILITY Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.